Okay, well, so in the interest of time, I think we'll go ahead and get started here. Thank you all for joining us today. This is part of the CWDL webinar series on key mortgage topics for our clients and friends in the industry. Today, we're going to be discussing hot topics in mortgage compliance. We have a highly regulated industry that's always changing, so compliance is always top of mind. We are very excited to have our guests, Troy Garris, co-managing partner of Garris Horn, LLP, and Josh Weinberg, president of Firstline Compliance, LLC, joining our own partner of mortgage banking, Dustin Pfluger. A couple of housekeeping items. We love interactions, so feel free to type away on any questions in the chat and Q&A area. We're going to do our best to get to all of them. If we don't, we'll circle back up after this. And other than that, let's get started.
Okay, well, thank you, Casey. And thank you, Troy and Josh, for joining us. We're glad to have you and have you guys on. So yeah, I mean, I guess, Casey, talked about the topics. We have a few topics we're going to lay out, but, one thing important that we kind of talked about on our prep calls is, is the theme throughout this is kind of be how to stay compliant, but also, try to still make money in times we're at right now. So, I mean, we obviously all have to stay compliant, but we've also got cost pressures. We've also got all kinds of other issues going on right now. So, yeah, I guess with that, we can kind of just jump into our first one, and maybe we, talk a little bit about, loan officer issues. We have a few topics we're going to cover in there, but, I guess right off, probably one of the biggest costs in the space is LO comp, and, probably, some of the biggest regulations are in LO comp. So, I guess, why don't we just start, Troy, maybe you can start off just giving us high level of, updates in LO comp, where we kind of stand on, regulations, just kind of go from there. So, yeah.
Sure. Thanks a lot, Dustin. And thanks for everybody for joining here, and especially Casey and CWDL and Josh, to everybody that's involved here. I do appreciate it. So let's talk about the basics of the rule itself for just a moment. And just to level set, the LO compensation rule, really, I think of it as two pieces. One is the Truth in Lending Act LO comp rule itself. That's the one, of course, where you can't pay differently based on terms of loans. There's a definition for that. We can talk about it if you want. Can't pay differently based on proxies for terms of loans. So that's the whole LO comp regular side. And then in addition, people sometimes forget about and leave out the concepts of wage and hours. You got to pay minimum wage and overtime to people, everyone in America, unless they're exempt. And there's this whole area that is sometimes left unexplored about paying either exempt or a non-exempt basis. So that's the basics. I'll tell you that on a day-to-day basis over the course of a year, probably on average, I would guess maybe almost a quarter of our time is spent on LO compensation related types of issues. And I think in particular right now, because the marketplace is so rife with just problems and people trying to find business and people trying in some cases to buy business, I think LO compensation is very top of mind, and people are calling either because somebody just ran off with a bunch of LOs, got poached, or somebody's coming in and LOs are trying to keep loans that they started elsewhere. It's the whole panoply of LO compensation and LO related issues. And I'll stop for a second and just Josh or Dustin, either one, if you want to dive a
little. I mean, Josh, I guess any thoughts on that? A couple of questions or two, related to it. Yeah, go, Josh. Any thoughts on just overall LO comp and what you're seeing too from your side?
Yeah, absolutely. So first, let me thanks everyone again for joining and for the opportunity to participate. Always a pleasure. What I will say, I'll kind of echo Troy's comments. I've learned to sound smarter. I just copy what Troy says and say it differently. Troy really is one of the leading experts in LO comp and for things related to the agreements and the structure and solutions for how to do it the right way, but to remain competitive in business. There's really few who are at the level that Troy is at. So that being said, we similarly get a lot of questions about, well, this is what I'm doing, or this is what I want to do, or here's what I'm seeing other people do. And the way I've kind of looked at it lately is the risk calculus seems to have shifted, while ideas or structures or practices before, because of the gray or maybe even tinging into the black and white side of can I do it, can I not, lenders had made a choice. No, we're just not going to do it because the risk of getting it wrong is too great. Now, with volume contracting and lenders really looking to try and win every deal they can, it almost seems like the risk of going out of business or the risk of losing an LO is becoming a greater risk than the potential LO comp violation. And so I just want to caution folks that not to be short-sighted. A short-term solution for long-term pain is not a good future plan. It really does make sense and is important to ensure that the actions we make today don't create catastrophic problems tomorrow. And when we're, as a compliance officer, or as legal counsel, or as tax trying to advise and guide people, we help to define that gray. And when it's black and white, and it's clearly on the side of not permissible, it's not worth taking that risk, even if it means we're not going to win that deal or we're not going to win that LO that time. The longevity in the industry is more important. And I certainly understand and empathize with the pains that every lender is dealing with right now. But some of these issues are just clearly outside the bounds, and taking that risk to do things the wrong way because we need to win it and think we're not going to get caught or think we're too clever in the way the documents generated that nobody's ever going to find out, that's not the strongest compliance posture to take.
So I guess on the opposite side, which I'll go to talk about, have y'all seen people, this year specifically, in the last year, come back and successfully, renegotiate LO comp and LO comp, with their actual LOs and stay compliant, come back and reduce basis points, maybe structure it differently, come out of a, put them into a branch model, take them out of a branch model. I mean, have y'all seen a lot of that this year? Or what are you seeing, to kind of, you don't get, just high level kind of examples of what you have seen that is successful or what people have been doing in that front?
So myself, I see a lot of people that have decided to do things differently as people come in. So recruiting out there heavily. And I think part of what you're alluding to, it's much easier to change compensation if it's somebody new to your place than it is if they're already there. That said, I think there are a lot of people who are being able to go back to LOs and say, look, we just have to do this differently. We can't operate in the manner that we're doing. And sometimes they're successful. Other times they're initially successful, but then they start getting LOs to either they're grumbling or they're leaving. And I think some of that is part of the, what is really pushing down to the LOs. I mean, the truth is, if you're not making any money and you're paying a ton of money to employees, something's got to give. You can't stay in business losing money and not reduce costs somehow. And if a big chunk of the cost really is money that you're paying to your production staff, in particular LOs, then something probably does need to change there. I will say that there are lots of people too that, in addition to the changing in the sense of, hey, instead of, make up numbers here, instead of paying 100 basis points, how about I pay you 90? Instead of that kind of change, it's more along the lines of, hey, I can't pay you 100 anymore the way we're doing it, but how about you take some of the concessions, which is not permitted, but sort of competing on compliance. And a lot of recruiters out there, again, this is all just what I hear sort of out in the marketplace, recruiters out there promising that, hey, if you leave where you are now and go to ABC Co., then they'll allow you to take the hit for concessions, or they'll allow you to get paid differently for FHA versus conventional, or jumbo versus conforming. So there's this, whether it's true or not, there's this rumor mill out there about people competing really on compliance. But true or not, I don't think really we know.
Yeah, I think on your first point there, I mean, we did these roundtable lunches in Houston and Dallas with Garrett McCauley back in early March, and I think
great show.
I was actually shocked. Probably 80% of the people there, they had talked about how they have successfully gone back and kind of basically laid everything on the table. Said, hey, here's what we're doing. Here's what the industry's doing. We're not any different than most anybody else. we're not making money. We need to structure something. Here's our biggest cost. We'll take a portion of this, but we also need y'all to, play, we need the LOs to play in this too, and kind of, and have been able to successfully kind of structure that. So, or renegotiate, I guess.
And I think that's good news. I mean, I think the complication, of course, is that it's really just the number, right? Like they don't have to change the way they're paying anybody if they do it that way. They really just got to go from the hundreds to 90, made up numbers, right?
Yeah.
Go up, if the company is losing money on every deal that it does, which is what the industry average was for last quarter, or even for last year, now that I think about it, the data out of MBA is that on average, which averages come with problems of their own, but on average, companies lost money on every deal. Something has to change, and that's one of the ways that perhaps you can address some of those problems.
I was going to make a very similar point. When you're losing money on every loan, volume doesn't solve that problem. And staff it actually makes it worse, right? If you're losing money each deal, the more loans you do, the more money you lose. It's kind of a perverse relationship. And companies have trimmed support staff and compliance staff almost down to the bone. And at a certain point, the company is as thin as it can be. And if the only other variable is LO comp, that needs to be looked at. And I realized for the LOs who are on this call, we're probably making some mortal enemies here. So we're not saying you need to give it away or give it back, just to be conscientious or holistic in thinking that the industry is cyclical. And we've gone through a long period of no trough cycle, and now we're in the thick of it. Margins will come back, rates will come down, inventory eventually will improve, and there will be times that things will be brighter. We just need to persevere until we get there. And I think those companies who are really able to take that team approach, who are really able to demonstrate what the LO is getting by staying at the company, take that competitive advantage. I think there's another element about technology and efficiency that really has come to play true now, where companies who took the investment to improve their efficiency and improve reduce their number of loan touches and increase their pull through, that's showing in material ways.
Yep, 100%. Okay, before moving on to other LO issues, we do have one question here probably for either of y'all. Can you pay LOs differently if the lead source is different? So like a corporate lead versus a self-source lead. Thoughts on that?
So from a legal perspective, I'd say the answer is, as you would imagine, it's not clear. My interpretation of the rule is that it is permissible, and what it has to be is to make sure that you are paying, in fact, on this corporate lead versus self-generated lead. And it makes a lot of sense, right? Because the real restriction is you can't pay based on terms of loans. Well, the question where the lead came from has nothing to do with the term of the loan or a proxy for the term of the loan, unless, and this is a critical part actually, unless somebody, the LO, can change the category. And we do see or hear, I guess, more commonly that there are some LOs have figured out ways to change the category. So somebody will come in and say, hey, I can get this deal done less expensively at a competitor. Can you do anything for me? And the LO says, I can't. I would love to, but I can't because the LO comp rule says I can't, and my company won't let me do it. But if you go apply through this other channel, whatever way it is, and that becomes the corporate lead, then I'll make less, and that can perhaps find its way to you, and the company might be able to do a loan less expensively. And so that part, I think, does create some potential risk. You got to lock that down. But as a general matter, just the lead source is not a term of the loan or a proxy unless they can game the system that way.
And if I could just add, I think this is one of those black and white that has turned gray. To Troy's point, on its surface, yes, it is permissible under the rule to pay differently for a company-provided lead versus a self-generated lead. But there's got to be documentation or support behind the legitimacy of where that lead came from. To Troy's point again, switching lead source because we're going to get the deal does violate the rule. if it's going to be a company provided lead, we should have some documentation or other support that the company had the way of finding that lead and providing it to the LO. I think this is one of the areas that we've heard probably more than seen, where lenders have been more aggressive or more creative in using lead source or generating multiple lead source categories. And that, I think, gets more dangerous as well. I think having two, company versus self-gen, that makes sense. If we're talking about a Facebook source and Realtor 1 and Builder 2 and my friend Joe 3, now all of a sudden convoluting the matter. And I think it's going to be far more difficult to tease out what is permissible and legitimate. And this is an area that I think regulators will be looking at.
And the gray area part of that, I think, is that, to Josh's point, you want to be able to document it. So there's no rule that says you can or cannot have multiple lead sources and pay differently. It just says you can't do this, pay based on terms or proxies. But so reading into that you can pay different based on lead source, if you have one or two categories, it's not that that's allowable and three is not, it's that you need to be able to justify when a regulator comes in because you're guilty until you prove yourself innocent in their view. Then you need to be able to say it in a 20-second conversation. Here, this is why we do this. This is why it's not a problem. And if you need the documentation, it's right here. And then typically they'll feel that, the regulators will feel that, okay, so you've thought through it, you've addressed the issue. They could still ask questions, but more likely they're going to say, okay, so let's move on to the next topic and continue on down the road. It's when you start to say, well, we think that this is okay, and we didn't really document this, but this guy comes, he's in a different marketplace, we think, and that part gets very flimsy very quickly, and they start pushing hard, I think.
Got it. Okay. So yeah, I guess just a couple other LO issues, and we can move on. I'm still amazed that we get calls about 1099 versus W2, LO, stuff like that. So I guess we had a good. We probably get a call a quarter at least that people are still 1099ing, and I thought the issue was mostly solved, but so I guess can you guys, I know we talked a little bit on the planning call a lot about this actually, just when it's appropriate, when you think it is allowable, or when it's at least a gray area versus when it's not. Whoever wants to jump in first can. So.
And Josh, go ahead if you want to. I'm happy to. I see.
Sure, yeah, I'll bat first and let Troy back clean up. So this is actually an issue that I think covers state requirements, and particularly for LOs and licensing, but also related to, like Troy mentioned, Fair Labor Standards Act and minimum wage and overtime and things like that. I'm going to steal Troy's thunder a little bit and remind folks, a 1099 and a W-2 is just a tax form for how income is reported. What we're really talking about is an independent contractor versus an employee type relationship. And the tension here is the federal guidelines or state guidelines often that carve out what makes someone an independent contractor are often in conflict with the requirements for sponsorship and licensing. So that is, an independent contractor frequently has to work independently, use their own equipment, follow their own procedures, use their own guidance and insights into how they do their job, work their own schedule. Contrast that with the requirements under licensing, where one, the company has to sponsor the LO. The LO has to use the company's systems and technology, follow the company's policies, be overseen and supervised by the company. It creates this tension where if you're following the set for an independent contractor, are you violating the requirements of a license and vice versa? I think there's some other issues, but Troy, let me let you correct what I said wrong or add to.
No, that's good. And Josh is right that, the main point is, are you an independent contractor reporting whose compensation is reported on 1099, or your W-2, which is an employee, right? So the employee, you get a W-2 at the end of the year, you file your taxes. By the way, taxes are due if you didn't file yet. Today.
Yes. Yeah.
And so in that sense, I would also point out that RESPA Section 8, which we'll talk about a little bit here, a little more detail, but RESPA Section 8 has a specific carve out. Section 8 basically says you can't pay referral fees and you can't split fees except for services actually rendered and received and so on. That referral fee is allowed to be paid to expressly to an employee. Well, if you set this person up so that they're actually an independent contractor, that exception allowing you to pay that person for referrals, which is what LOs do, they refer you the company loans. So being able to pay for that referral is illegal if they are in fact independent contractors. And there is a lot of confusion out there, and people will talk about W-2 employees, 1099 employees. That's not really how it works. Again, those are just IRS form numbers. The real question is, are they independent contractors or employees? And I think there's a lot of tension there. And also people will frequently tell me, well, I called my state regulator. My state regulator, the licensing authority, says that they don't have a problem with me paying my LO sponsored by me on NMLS on a 1099 basis. And my thought is, they don't really care a lot of times. That's just an IRS form. What they do care about is whether they are technically sponsored by you or sponsored by somebody else. And if they're not, you have a licensing issue. But if they're out there and like Josh described, they got your name, your company name on their business cards. They work just for you, and they're sponsored on the NMLS just for you. And they're out there writing loans in your name, and you're paying them on a RESPA permitted basis as an employee. Then I'm not quite sure how you're going to argue that those people are independent contractors. And I think it's a pretty big risk. One other side point that I'll note is that I also, and this is sort of like a Haley's Comet issue, I frequently will come into contact with people who are saying, well, we're not paying the LOs directly. What we're paying is we're paying an LLC that they own, and that's separate compensation structure, and that is also an issue. Again, it's Haley's Comet type, comes around for a decade now.
Sorry, one quick follow-up to your point about state regulators. I was at the NMLS conference a couple of weeks ago, and I actually did a survey of quite a few of the state regulators on this point. And the phrase that I got back from Oklahoma, which I thought was telling, is our general counsel's position is it's not disallowed. Not that it's okay, it's just not disallowed because it's not written into the statute. So take that with a grain of salt. And Dustin, maybe a quick question back to you. It seems like maybe there's some risk from the tax and employment side that an independent contractor isn't going to have withholdings. There aren't going to be things like Social Security or Medicare or those other issues, and that may play into some of the risk as well.
Well, yeah, I mean, I think that's what we always bring up. I mean, we don't bring up the compliance side. Obviously we will refer out to you guys for that kind of issue. But yeah, I mean that is. I mean, if you control, I mean, if you meet all the standards of being an employee, you control their schedule, all the stuff we just walked through. They have your business card, they do all that. I mean, it's going to be very hard for you to argue if you got an IRS audit that you shouldn't have paid payroll taxes, you shouldn't have gone through, that you shouldn't have withheld all that kind of stuff. And it's going to be a very hard argument for you to win in that case. I think this kind of actually leads into kind of the next kind of point on this. And because where we see it a lot is with, real estate agents, kind of dual employment type things. And I guess just factoring that in, I mean, what issues have you guys seen, when companies like, oh, we have a real estate company and a mortgage company, and our employees are licensed on both, and maybe one's a 1099 here, not there, whatever. I mean, so where do you guys see the risk there, or the issues, something like that?
Yeah, Josh, want to jump again?
Yeah, thanks. I'll jump first here. And these were also questions that I surveyed the state regulators on at the NMLS conference. And there was a broad brush of opinion. Some were totally fine with it. Some said, nope, absolutely not allowed. Others had said, well, we're actually in the process of promulgating regulations related to an LO being an insurance agent, because the LO is W-2 comped and the insurance agent is 1099 comped. So that's not explicitly allowed, but we're okay with it. So we're promulgating regulations. So when I said, well, what about a realtor? And they said, well, we haven't talked about that yet. So I think proceed with caution. I'll also say what a lot of lenders and state regulators relied on was guidance from FHA and HUD. And so going back a few years, HUD had said, your employees must be exclusively your employees and may not have other employment, and then watered that down a little bit and said, well, we're okay with dual employment. There just can't be a conflict of interest. Fast forward to, I think it was December of last year, where they came out with a new mortgagee letter basically saying, well, we're okay so long as the LO is not an underwriter or an appraiser or an engineer. I don't know why engineer got included because I don't think that's really applicable. But basically, is the LO able to influence the decision on the loan? And if so, that's too much of a conflict. Ironically, last month, I believe it was, USDA came out with guidance basically saying, no, can't do it. So usually USDA is pretty in line with FHA, or maybe a little more lenient, but now we see USDA saying, no, this isn't permissible. In general, and speaking with the state regulators, many of them were not hugely in favor of it, but took a similar approach where it's not specifically written into our regs that it's prohibited. So we recommend proceeding with caution. From where I sit, I think the important issue to look at are twofold. One, conflict of interest. It is having an LO in more than one capacity, giving them the influence to direct or steer or proceed in the transaction where it otherwise may not have. And two, if someone is needing to earn compensation twice from the same transaction, are they highly skilled and valuable at both? Or are they trying to bleed as much as they can from one because they don't have the skill set to stand on their own in both situations?
I think adding to that, Josh, the concept of RESPA is that the services have to be non-duplicative services, and otherwise it could be considered a referral fee or fee splitting. And you're right. It was in the past. It was FHA. Most lenders of significant size had FHA approval, and FHA was a significant part of their businesses. And the FHA handbook basically said you can't have a person be both a real estate agent and loan officer in the same transaction. And as you said, it's been modified over the years. But it's been around for more than a couple of decades in one form or another. There's also a regulation that people don't frequently look at, but I think it's 202.5 of 24 CFR. In there specifically, they also have a conflict of interest type of a provision built right into the regulation. But essentially, FHA said, okay, handcuffs off, at least with regard to FHA. But nobody has really explored this much in a couple of decades because almost everybody was FHA approved. Almost everybody said you can't do it. And now we have this compilation of pressures. On the one hand, you have everybody looking only for purchase business, pretty much. The realtors, as always, typically control the leads or the referrals in the purchase market. And you have lenders looking for ways to tamp down or potentially cut in terms of costs. And they're thinking, well, what better way than to have my real estate agent or my loan officer also be a real estate agent, or vice versa, real estate agent be a loan officer. And that can cut down some of the costs because the person's making money in both transactions. Now, I would say that the real estate transaction and the agreement that they negotiate there and so on, that work is very different from the work that they would do for the finance company, the financing of the transaction. In fact, there are a lot of cash deals, and they are, there's real valuable real estate work that goes into cash deals, even unrelated to financing. And there are financing deals like refis, for example, that are completely unrelated to a real estate transaction. Those are definitely segregable, and you can make the argument that they're both valuable, and you can pay for both of those. And they're getting paid, by the way, by different people, right? So on the one hand, the lender typically is paying the loan officer, and on the other hand, the seller is paying the seller's agent that then splits fees permittedly with the buyer's agent. So there is a wide variety of issues that people can poke at. I do think that, like the USDA, which only involves USDA loans, by the way, it doesn't say if you're a USDA lender, you can't do it. But on USDA loans, you can't do it just because of this change last month. But I think that we're going to see people like the CFPB in looking into this. Whether they prohibit it or not is a good question, because I would argue that in some ways you cut out one of the people, you can reduce costs, and that would be good for the consumer probably. But I think the CFPB will be looking at this from a UDAP perspective, from a RESPA perspective. Some states, like you mentioned, there's going to be some sham employment arrangements questions that come up. And so, I think it's an area that, it's always bad when your lawyer says, you have a very interesting legal problem. And I think that's what this is going to be, is an interesting legal problem that gets shaken out over time.
One other quick comment to add in. Sorry, Dustin. I wonder about affiliated business arrangement disclosures. So typically the affiliation is not going to be between the lender and the real estate company, but when the individual is playing more than one role, I would still recommend treading lightly and certainly not requiring use and even providing an affiliated business arrangement disclosure as a safe caution if it were approach that were taken.
Yeah. It raises there's this whole rabbit hole we can go down on that issue, but I think disclosure is definitely important. I think the required use is definitely important, that you're not requiring use.
Okay, one quick question, then we'll move on from LO. One person asked, how do you recommend calculating overtime pay for loan officers? So if you want to keep that relatively high level, we can answer and then move on.
Yeah, so I think it depends I'll just talk loan officers. There's a different analysis for branch managers usually, but for loan officers, you either have one of two things. Either you're paying on a non-exempt basis, in which case they have to be paid for minimum wage, they have to be paid for overtime, and there's some special rules for calculating that on a commission basis, and essentially they can't be paid any less than the minimum. And they do have to be paid for hours worked. So you got to track hours, and you got to, administratively, it's a hassle, but you got to look back and make sure they got paid for each of the overtime hours they worked at the premium rate. Again, there's this whole, if you get into the weeds, you can spend this whole conversation on that. That's on the non-exempt side. There's an exemption that is an imperfect fit, but there's some good guidance out of the Department of Labor back in 2004 and 2006. That talks about outside sales exempt people. You got to be careful there, and there's some licensing issues that flow into that as well. But the benefit of the exemption is, if in fact you meet that exemption, you pay however you want. You can pay salary, you can pay commission only, you can pay nothing if they don't close any loans. So there's this dichotomy, and you got to figure that part out.
Okay, well, let's jump in. I'm actually so hopefully I don't throw you off here. I'm gonna switch in order because Josh has been bringing it up a lot, but I want to move on to state compliance next, and then we'll move to fair lending after that. So Josh, I know you were out at, the MLS conference a couple of weeks ago, hugging your regulator, as you like to say. So you were out there talking to them all. So I guess just coming out of that conference, what were the kind of the hot issues? What would you see? What were your thoughts coming out of that?
Yeah, so to the hug your regulator point, let me elaborate a little bit there. To me, the highest value of being at the NMLS is the face time with the regulators. Regulators are people too, so having a relationship with them helps. It's not a silver bullet or a bulletproof vest, but when they know who you are and get an understanding for what you represent and what you do, it does make conversations with them easier, and they're more likely to respond. Think about it like an LO with an underwriter. Underwriters know the LOs who send them a clean file. They have a tendency to review their files first versus the ones that send them really difficult files. Similar construct. The conference was really good. A lot of topics that came up. Two highlights that I just think are almost like public service announcements to make sure people are aware of. First is related to call reports. We are currently using version 5 of the call report. Version 6 is going to be released soon. Actually, on the NMLS Resource Center, there's a definitions and example format. More than likely, implementation time is over the next 6 to 12 months, so still yet to be determined. The biggest impact there is we currently have the standard and the expanded versions of the call report. The expanded is for people who have an agency approval. The standard is for folks who don't. Version 6 eliminates the 2 versions, and there will be just 1 version of the call report. And so all people that file a call report will have just this version 6 to use. Obviously, someone like a mortgage broker or someone who doesn't have an agency approval or doesn't service, there's going to be a lot of fields or information that are just not applicable. So the NMLS system is attempting to populate fields that would not be applicable based on license type and business activity with zeros. And if there was a field that was not pre-populated with the 0, then a lender would populate it with the 0 for fields that are not applicable. So I do recommend people look at the version that's available on the Resource Center. Certainly reach out if you've got questions. We spend a lot of time helping folks with call reports. The second is related to the disclosure questions. So anyone who's ever filed on the NMLS, if you're an LO, you have an MU4. If you're a control person, you have an MU2. The company filing is the MU1. These different filings all include questions that have to be asked. Have you ever been convicted of a felony? In the last 10 years, have you had a foreclosure or a collection or things like that? The disclosure questions went out for public comment. The public comment period closed, and CSBS and ARMOR and NMLS are now in the process of finalizing their review of all those comments and finalizing the final versions of those disclosure questions. A similar 6 to 12 month timeline for when those will go out. Just again, public service announcement related. When those are released, make sure to review those. Some questions that were yeses may now be nos. Some questions that were nos may now be yeses. And it'll be important when there's a change to have an explanation as to why there's a change. And there is the opportunity to provide an explanation. Well, every yes response requires an explanation. Even a no response allows the opportunity to provide an explanation. So in general, the information provided, less is more, so long as it's complete. So again, if there's assistance we can provide, we'd love to help you with those. If there are questions related to legal matters, folks like Troy and his team certainly can help on those. But those are 2 pretty significant changes that will be coming to the system in the near-term future.
Okay. Question I have on this. I mean, we get this question a lot at this time of year, or let's say probably 2-3 weeks ago, it would have been a little bit more timely. What happens if they miss, state filing deadlines, and like what is the implication? What should they do? I mean, I'm specifically speaking to financial statements, but the audit's not done, that kind of thing. I mean, can you talk just a little bit through that?
Yeah, this question actually came up at the NMLS Ombuds meeting. And there was a little bit of a variance in response based on the regulators, because some regulators have timeliness and accuracy filing requirements in their statutes and regs. So states like Connecticut, if it's not filed on time, there can be a fine and a consent order. Other states have a prescribed $250 fee for being late, but there's no consent order or no issue behind it. I think just about every accounting firm except for CWDL has missed or been behind in terms of completing audited financials. I think the reality is everyone's been busy, and particularly in the audited financial component, there's probably 2 sides to it. One is, did the company provide enough information to complete the audit? And the other, did the accounting firm have enough time to complete it? The state regulators were pretty, I think, deferential in their response to this, and just said, communicate with us. If your auditor is running behind and not able to complete it on time, let us know. In Connecticut's perspective, they communicated, you've had to do some work on your financials before you've provided them to your auditor, so file with the best information you have. And then when you get your audited back, update it. The call reports allow you to refile for up to 2 years after you filed, and those corrections are not typically penalized. The expectation is, as information changes or is corrected, you would update that information. So make every best effort to file on time. If you're not going to be able to meet the deadline, put the information in as best as you can, and then be communicative with the regulators so that they understand the reason why you haven't provided it isn't because you're being negligent or just don't care. It's because you're waiting on a particular piece or part to be completed in order to do the filing. Okay,
perfect. Troy, from your perspective, and this is a little bit outside the state piece, but what are your thoughts on, the HUD, HUD issue specifically with that? I mean, they obviously have a 90-day, filing requirement as well. I mean, what have you seen? I could chime in a little bit too. What have you seen there from their perspective?
Yeah, it's a great question, and also to Josh's point too. I think just on the answering of those questions, be very careful, and I would say read the questions really carefully, because people answer incorrectly, and the regulators are not always that sympathetic if you misstate something in there, one way or the other. Actually, it can make you look worse than you would have otherwise. But still, read the question carefully and answer that question. Don't be misleading, don't say it in a way that misleads, but read the actual question or answer the actual question. And then as far as timing goes, you're right. I think that there's the deadline that is 90 days from end of your fiscal year, which for most people, calendar year, and then you're supposed to do your recertification with HUD in the FHA. If you miss the deadline, there can be some ramifications. There is a potential grace period, a short one, that follows for about 30 days. I wouldn't rely on that, and I think, Dustin, you could probably talk to this better than any of us, that don't rely on, I'll just get this information to Dustin on March 30th, and then they'll figure it out and I'll have this little grace period. Dustin will probably turn you down, is my guess. But get everything done that you can fast, and then don't certify unless you're ready. Just click unable to certify and explain why you can't, and then get it in as fast as possible. The regulator, FHA, doesn't like that approach, but they also are human and they understand that things happen. And if you're working hard towards what they think you need to be doing, then they're usually empathetic, if not sympathetic. And they're good people. They'll tend to work with you. If you go past that deadline, you'll probably catch a mortgagee review board case, and we get those. We get a number of those every year, and those are painful, and it drags out for a long time. You spend a lot of money and wasted money and time, in my view, because the fact is you're going to do it sooner or later anyways. Do it on time. Don't put it off.
Yeah. And that's what I'm glad to hear you say, because that's usually what we echo too, is we try, our best to get it, done and get everything there. But we do have, on occasion, every now and then somebody, and they always ask that question. That's basically, I was like, I wouldn't rely on this, but what we've seen in the past and from our experience, and especially if you're not a repeat offender, that if you don't submit on the, by 90 days after, you usually get a delinquent filing email, and then it says you have 30 days to cure that, basically, or as soon as possible to cure it. And, we've noticed if you get it done, within 30 days, and
they really dislike repeat offenders. That's one thing, and I'm glad you mentioned that. They also they come with people with ferocity for what they view as false statements. So no matter what the facts are, no matter how bad it makes you look, what they view as lying about it makes it much worse. And they'll, even if they would have forgiven you on the first instance, the mistake, they will come after you almost for sure.
That's a good point. It's something a little bit outside of this topic, but just to add, that's what we've noticed too. And in the significant findings or any self-reporting, especially like this year, the 20% of equity, like loss reporting issues. We've always found that it's a much bigger issue if you don't report it and they find out, which they will find out, than if you don't report it. Then if you do report it, usually if you do report it, it's basically, I think slap on the wrist, but you have to provide financials, I think quarterly, until you become positive for 2 quarters or something like that.
Yeah.
But you don't go through MRB. You don't have, you don't have any issues. But if you don't report that, you're going to have, much more significant issues if you don't report those.
They treat it very much as, it's the government, but they treat it very much like any business and an insurance company. They're an insurance pool in a sense, right? The FHA anyways. And their position a lot of times is, look, if we can't trust you, we don't want to do business with you because you're putting us at risk. And so because we're the government, they can't just turn you off the way that, somebody, a Fannie or a Freddie or some other investor might, or a warehouse bank might, but they'll have a process and they'll turn you off.
Yep.
Two just quick comments there. Within LEAP, there is the opportunity to request an extension of your filing. And that gives you almost an automatic 30-day extension. There has to be a reason provided for why. Leverage that. If you can get that, and hindsight 2020 for anyone who missed it already, but for next year, if you find yourself in that scenario, request the extension at least a week or so before the deadline, provide the explanation, and instead of March 30, you'll typically have until April 30. So it buys you some additional time without getting the naughty email. And to the point Dustin was making about the requirement to report based on the minimum net worth, there is the requirement for a notice of material event. And I think that's where we were talking about that if we fall below that 20% or greater of its net worth, we've got to give the NME and the corrective action plan to indicate what we're doing to correct it. Not doing that will come back to bite us. And if we were to certify saying we met all of the requirements and stayed in good standing with all of FHA's guidelines, and then it turns out, well, actually, we didn't report this 20% drop in net worth, that could be seen as a false certification. So these issues become intertwined, and then you end up working with Troy to try and get out of the rat's nest.
Well, I mean, and that's any material event, any notice. I mean, there's a list of them. They're always listed there. I mean, I know Troy and I have worked on a client together that, they gifted shares of stock to a family member and, didn't disclose that, and caused them all kinds of problems. And it wasn't like they were selling stock. It wasn't like they literally gifted it out there. They didn't disclose, they didn't file that, change of ownership and whatnot. So yeah, okay. I guess just the one other quick piece on state, this may be state licensing overall, kind of just licensing compliance type stuff, and then we'll jump into fair lending relatively quickly here. But on the whether or not to use a DBA first, company branch, team names. I think obviously right now a lot of people are buying up branches, buying up other companies, and keeping that maybe possibly as a DBA, or keeping that, what are y'all's thoughts on around the compliance side of that, and where are the red flags, and maybe spend just a couple of minutes and we'll jump into fair lending for about 10 minutes. So.
Yeah, so I'll swing first on this. This is a question we really get a lot. And again, one of those issues where there's a lot of variability based on the states. So the most important, I think, key concept is the consumer needs to know who they're working with. So if I'm 123 lender and I want to market as the Josh team, if I'm working under 123 lender's website and I have 123 lender's logo and the Josh team is more like a tagline, some states have no issue with that and do not require it to be listed as an other trade name or a DBA. Other states see any name related to any name that's going to be used in marketing or held out to consumers is required to be registered as an other trade name. And that often requires registration with the Secretary of State or the applicable associated entity within the District of Columbia or other areas, where you both have to register that name, have it included on your surety bond as a rider, and it has to be listed in the NMLS. So I wish I could give you a one-size-fits-all answer to that, but there really is a lot of variability based on states, and my dog agrees.
Troy, anything you wanted to add there?
No, I would just ask Josh: is there an issue with for the states that don't require it? So the Josh team, let's say your state that doesn't require it, is there any downside to putting it on there anyway, other than the filing fee and file with whatever county or state office you need to?
Yeah, so again, part of that varies based on state to state and just their comfort level. And again, I kind of back to the original point, it's just got to be clear. The consumer needs to know who they're working with. And that's both for a state licensing law. It could also come into TILA, where you're required to list your contact information and things like that on the LE and CD. And there's actually a case that CFPB brought under unlicensed activity and UDAP, because there was someone using a team name that wasn't registered or clearly disclosed. And so the Bureau felt that was deceptive because the consumer couldn't track them down to identify the company they worked for and that they were authorized to conduct business.
Yeah.
Okay. Well, let's jump in. I mean, I know we probably could spend another hour talking about fair lending, but we got 10 minutes. So, we can kind of talk to hit the high stuff, I think just to start, something we talked about just at the beginning of this call we got on is, I think there was a HMDA memo that came out yesterday. I think Josh, you got some clarity on it. If you just want to kind of, to talk through, what the memo was, what the clarity was, and we'll go from there.
Yeah, so I think there's a couple of pieces. And sorry, let me make sure I'm answering the right question. Ask me one more time.
Talking about the HMDA memo that came out yesterday.
Oh, thank you. I was going to go down a different rabbit hole. So as we were talking in our prep, if you want to get compliance people in a tizzy, send them a notice saying their HMDA data is wrong for the last 3 years. So the CFPB yesterday sent out a rather general email that seemed to be a pretty specific call to action. And so it basically said, it seems that there's issues or errors with the subject property address filed for HMDA. It looked or appeared as if it went to one specific lender, but it actually went to the majority of HMDA filers. And so I reached out to a friend at the Bureau to try and make sure that I had the right guidance or interpretation. And there were a couple of responses back. The initial response was, this sounds more like a general best practice kind of guidance email, but let's get some more context from the HMDA group. They followed up later to say, well, actually, anyone who got that email potentially has an error. And so if they have an error, it's kind of incumbent on them to review it and determine whether they need to refile. So I think this is going to be an ongoing issue. We spend a lot of time working with folks on HMDA reviews and HMDA scrubbing. And so what I would say is, based on the email, I would not do a full reanalysis and 3-year look back. I would do some spot checking. Reach out to the Bureau to get more clarification if you have concerns about your specific scenario, or we'd love to talk to you and drill in a little deeper. If you do a spot check and you see that your data is largely accurate, and you used a HMDA scrubbing tool and went through the HMDA filing system and did not get validity errors or syntactical errors, you're probably okay. If, however, you've done some spot checking and seems like there's some errors or maybe problems, as one example, if you have a property address listed as, say, 61 to 66 South Main Street, that could be problematic. Usually it should be one address, 61 or 66, not 61 through 66. There was also some confusion over new construction loans. So I've taken an app for a new construction loan. I have a street address, but I don't have the numeral yet because it hasn't been assigned, but the borrower withdraws before we've gotten the numeral. Should that be reported as NA, or should that be reported as just the street address? Unfortunately, the Bureau's help desk, HMDA help desk, has given 2 different answers. One saying just use the street address, one saying file NA. So I've reached back to try and get some clarity on which is the right approach. So stay tuned. But again, I would say don't panic. Compliance folks have enough on their plate right now to be dealing with in an already tense environment. And this is one where we probably need some additional guidance from the Bureau. So outside of that spot check to ensure that you don't have blatant errors, I think we're probably going to be okay.
Okay. Okay. So, we have 6 minutes left here, so I'm going to change this up a little bit. Let's just, with fair lending and what we got left, either, how about y'all each cover one, significant hot topic? It can be, your Townstone case, Troy. It can be, CRA for non-depositories, whatever you guys want to do. So why don't you, Troy, you shoot first, cover something, and then we'll go to Josh, and then we'll wrap up here. So. Okay.
So, well, I'll just say on Townstone, that was just really an interpretation of the statute. The statute defines the word applicant. So the court said, well, if Congress defines something in the statute, CFPB can't go beyond that and change it. And actually, it was the Federal Reserve at the time that did that. But that's on appeal. We'll see where that goes. It's the 7th Circuit. Hopefully, now we will be in that circuit. So hopefully, we'll be able to prevail there also. And then I will just say it's really a broader topic, that there is the CFPB with the COA, Equal Credit Opportunity Act jurisdiction. There's HUD with Fair Housing Act jurisdiction. and all of the regulators. You can even have at the state level regulators coming in. But I would say just to really be super careful right now. Fair lending continues to be the hot button issue of the day, and there's this entire wave of much more than just fair lending. This entire wave of notions of equity and fairness, and what does that all mean, sweeping through the country in all areas. And in our small area of lending, I think it's possible to just focus on casting the net wide. I think the CFPB and HUD are both quite wrong on what the law says and how it works. I think they're flat wrong on that. But nevertheless, what they're encouraging people to do is to go out and find people that you can hire to reach out to borrowers maybe you didn't have yesterday, whatever they are, whatever classification or category. So cast the net very wide, and you'll probably make some money and probably help the world in the meantime, but you'll make some money at this too. And I think that's where I would focus my own, my 2-minute version of it.
All right. Thanks, Troy. How about you, Josh?
I'll echo Troy's sentiment that I feel now there's been a slogan that's been used for a while: do well by doing good. I think that's really more less a slogan and more almost a business requirement these days. A topic that I'm seeing and is passionate to me is limited English proficiency. I could go on for hours just on that topic, so I'll be brief to the best I can. I'll say that in general, the role of regulators, particularly federal regulators, is generally to oversee and supervise the majority of the market. So as the majority of the population is speaking a language other than English, expect to see more regulation and coverage over that area. Many lenders have frequently taken a English-only policy approach, and I think we're seeing that carries fair lending risk. So the Department of Justice has been on a targeted approach or methodology of tamping down on fair lending and redlining issues. Their most recent settlement was with Park National Bank out of Ohio, and it was the end of February. And one of the issues they cited was that Park National Bank failed to serve limited English proficiency borrowers. That while they had a lot of Spanish-speaking consumers in their market footprint, they had virtually no Spanish-speaking loan originators and failed to do advertising or outreach to Spanish-speaking consumers as well as African-American borrowers. So I think stay tuned. Again, pretty soon you're going to Google me and LEP is going to come up behind it. So I'll be in Austin in May talking about this at MBA Legal Issues. Happy to talk about it with anyone else. And there are some technology solutions to help with this issue. And just to, I've been quoting her a lot these days, but Rosalind Hardy made the comment back in December at a California MBA event. And she said, you know what, guys, it's time to climb the trees. The low-hanging fruit has been picked. And what I think she's really meaning there is there are a lot of borrowers out there who want loans. They just don't look like and sound like the borrowers we've primarily been serving over the last few years. So finding new ways of working with additional borrowers is going to be really good for business and really good from the fair lending risk.
Okay, well, perfect. Well, again, thank you guys very much. I was worried about running out of time, and we were right. We didn't even get to two of the topics. So, but I think we hit the key points, and I think we got a lot out of it. So thank you guys very much. And with that, Casey, you can kind of wrap us up. So
yeah, you bet. Josh, Troy, thank you so much for jumping on with us today. That was a wealth of knowledge. We will be sending out a recording, so keep an eye out for that tomorrow. And then as you close out, there's a quick survey for CWDL and all of us. We want to make sure that we continue to bring you guys the relevant topics that you're looking for. So that being said, everybody have a great day. Thanks for joining.
Thanks, everybody.
Thanks so much, everyone.
Thank you, guys. Thanks, everyone.